A quick update as always with the portfolio, and then talk about what I'm going to be doing with options contracts that will be expiring at the end of this week. As you can see here on screen on the bottom, I have Ford and Tesla options that will be expiring. I'll have to deal with those by either rolling those forward, at the same time buying and then selling off contracts, or what I could do, since there was a very strong day in the market today, both of those stocks traded up quite well today. We'll go over that in today's video. I could buy those contracts back, and then if the price does start trending back later in the week, at the end of the week, I can sell those off and make more profit, more lucrative contracts, than simply trying to roll those forward on a very green day for both of those stocks. But before we do that, let's take a quick look at the portfolio. As you can see here, a very strong day, up 6.35%, 26,564 in the green, helping the portfolio now turn positive for the week, 1.14% in the green, 4,995 1 month, 3.13% in the green. 3 months, still some work to do here, down 15,650, 3.4%, and year to date, up 38,519, 9.48%. So far, a very good start to the year. Definitely pulled back here, but today, very, very strong performance. At the bottom of the screen here, if you do click on that, it does go through exactly what expiration, exercise, and assignment means. A very nice little tutorial for anyone that is new to options contracts. These can get quite complicated. What essentially I'm trying to do is avoid assignment, this particular end of the contract here. So if a contract is assigned, I have the obligation to either buy or sell a stock. So if it's a call contract, I'll have to sell off a stock in my portfolio. If it's a put contract, I'll have to buy the stock. And there's no way to get out of that. It's an obligation. It's not like when you buy contracts, you have the right, but not the obligation. When you sell off these contracts, I have the obligation to do what the particular contract says. So if it's a call contract, I have to sell that off from my portfolio. And if it's a put contract, I have to buy that stock, which unfortunately has a lot of tax complications, which really got my portfolio into trouble last year, trying to do some tax loss harvesting because of contracts that were assigned. And that turned into a very, very bad trade for the portfolio. That was my mistake, but that is what I'm trying to avoid. I'm trying to avoid any assignment of these contracts. You can see all of the contracts here. Ford contracts, 1285 call, 1235 call, again, meaning I would have to sell those stocks off from the portfolio for both of those strike prices, 1285 or 1235. If the price of the stock did get up that high, you can see plus 100%, plus 150%. If you take a look at the contract, it's only 2 cents here. On the bottom, total return, 12,023. So far, a very successful contract. The 1235 as well, it's 5 cents per contract. But at the bottom of the screen, total return, 704. So those are both in the green. And then really what I would like to see here is very large negative numbers. You can see the Tesla contract, Tesla 177.50 put, negative 86.35%. Ordinarily, if that was a stock, that would be not what you're looking for. But here you can see the price of the contract is going down quite dramatically here, $1.28 down to 37 cents. You can see negative 3 for contracts. So I sold these contracts off. So essentially, I received for this contract, or for these contracts, 3 contracts, $16.05. If I were to buy those back, I would still make $14.94 because I'd buy each of these contracts back for 37 cents. The next week, or at the end of the week, I can sell these contracts off again. If the price of Tesla does start to trend down, this 37 would go back up, to $2, $3. At one point, the contracts here are up over $8, so $800 per contract. Each contract is 100 shares, so each stock, $8, for example, times 100, $800. And I received here an average credit of $535. So $535 times 100, $535 per contract. So there's a couple different ways I could deal with this contract. If I click on trade, I could roll position. You can see the first contract, again, up on top. I'd buy those contracts back for 37 cents per contract. So I'd have to spend $37 for each of those contracts. So it's 37 cents per share, 100 shares per contract, $37 per contract times 3. I could then select a new contract here. Let's say I wanted to go ahead and roll for the same price for next week. So March 31st up on top would be the expiration date when the contract would expire or be assigned. If I go down to 177.50, you can see Now roll that forward, I would receive a credit of $1.62. So up on top, the net credit, again, buying back the contract for 37 cents per share, $37 per contract, selling off a new contract, $1.62 per share, $162 per contract, I would receive a net credit of $1.25. If I continue that times 3 contracts, I'd receive $3.75 for that particular trade. But that's not the kind of income I'm looking for the portfolio. So if I simply go back, I could do click trade. I could view all options on the top. Go to March 24. Instead of selling off a put contract, I could buy a contract back up on top there. I could go down to the 177.50. Enter into that contract to simply buy that back. Buy back all 3 contracts. If I click on review, you can now see that I'll be buying back those contracts. And at the bottom of the screen, you can see I'm paying $114 to buy back 3 open contracts, which will release collateral and remove your obligation to buy 300 shares of Tesla for $177.50 each on or before March 24th. So I could simply buy these contracts back, and then if I go back to the trading menu here, I can now click on sell put contract, move over to March 31st. And what I'm hoping is that if the Tesla price does pull back a bit, the options contracts will also increase in price. So for example, if I go back to 177.50, this contract here, instead of being $153, I'm hoping this goes up to $300, $400, $500, depending on how quickly and how deeply the price does pull back. Or I can simply pick a more aggressive contract to make more income on the portfolio. So in the middle, share price $197.50. If I were to click on $197.50, I'd be receiving now $740 per contract. So that's something I could alternatively do as well. This is what I'll probably do tomorrow. If the price of the stock does trend up, I'm definitely going to buy those contracts back. And then at the end of the week, if it does pull back, sell off additional contracts. So I hope that makes sense, but there's 2 ways to do that. You can do trade, roll position, but you have to do both contracts at the same time, which sometimes it's very hard to have these contracts execute in the portfolio. Or you can simply buy back the contract and then sell off an individual contract after that point. So you sell off 2 contracts, gambling that the price of the stock for put contracts will pull back, and for call contracts, the price of the stock will continue to rise in the future, which will impact both of the stocks. Another video, I'll go over some of the Greeks. This is really a way to assess risk in options contracts. Each of these particular numbers mean different things. You can use these to guide the selection of which options contracts to take a look at, especially for risk. You're really looking at these contracts as gambles for the most part. I like selling off contracts in stocks that I'm more than happy to hold in the portfolio. So for example, on that Tesla put, if I had to buy that stock for $177.50, I'm more than happy to buy that stock for $177.50 and then holding longer term in the portfolio. I have done contracts. Let's go down to the bottom of the screen here. I have some lists for options. For example, CGC, Canopy Growth. This is a stock that I would not want to hold in the portfolio. You can make quite a bit of money on these types of stocks, these penny stocks that are risky. But if the contract were assigned, if I had to buy those stocks, that'd be something I would not want to hold long term because that's a very high risk stock. Ford, Tesla, more than happy holding those in the portfolio, but stocks that are very risky, which you can get more contract income from, more contract premium, you don't want to hold those long term in the portfolio. So I only try to do this strategy in stocks that if I did have to either buy or sell the stock, I'm more than happy to do that at the particular strike price that I entered. Yeah, sometimes I do get a little bit risky with these options to make more income, but for the most part, I'm more than happy to sell or buy stocks at these particular strike prices that I have put in the portfolio. So I just wanted to quickly go over that with the portfolio. I'll update you guys tomorrow on exactly what I'll do. But again, I'll probably buy back those contracts, and if the price of the stocks do pull back, I'm going to sell those off for more options premium in the portfolio. So with that, I'll end the video. Again, if you guys enjoy the content on the channel, if you guys enjoy the video series, feel free to like, share, and subscribe. Till next video, we'll see you then.